All right, so today I'm going to be covering the other topic, which is financial leases, financing lease, and there are four core concepts that define any capital lease as a financing lease. So we will go over those to begin the video. The first is if the lease agreement transfers ownership to the lessee before the lease expires. So in any case, some leases, when you pay off the loan completely, you can actually retain ownership of the asset. And that kind of leads into the second point here. The lessee can purchase the asset for a bargain price when the lease expires. So basically, essentially giving the uh, lessee the option to actually purchase this asset when they're finished with the lease. Um, Additionally, some kind of um, components of financial leases will often offer the lessee an exchange um, constant rate for multiple years so that they can avoid paying fluctuating interest rates on the debt, as well as an option to extend the lease for multiple years after it ends. So the third point is the lease lasts for at least 75% of the asset's estimated economic life. And that's regarding the asset's uh, useful life. So we depreciate assets over the course of their useful life. And if any lease lasts for at least 75% of this useful life, then the lease needs to be classified as a financing lease. Okay. And the last point is the present value of the lease payments is at least 90% of the asset's value. So we can value an asset in the same way that we value a stock. Uh, if this asset's value is, greater than or less than 90% of the present value of all of our lease payments, and I'll show you how to calculate the present value of our lease payments, then we need to, by classification, make this lease a financing lease in our books. Okay. In the last video, as I said before, we covered the operating lease. Those are kind of very attractive leases for people because you don't need to actually include them on your books as a liability. You can actually expense them away, and yeah, so that makes them very attractive for investors. Um, but today we're going to be talking about the financing lease. And the financing lease is different because when we talk about showing you an example of a financing lease, we're going to show you an example from the lessee's perspective. In the previous video, we covered a lease from the lessor's perspective, so the person who actually collects the lease payment. In this video, we're going to be covering a lease where we're going to be covering it from the perspective of the person that's paying the lease payment each year. So it gives you kind of the opposite end of the spectrum, and it's very useful in order to illustrate that leases are a zero-sum game, like most concepts in finance. And a zero-sum game, basically, it means that the seller's gain is the buyer's loss, and vice versa. So it's a pretty fundamental concept in finance. If you haven't heard of it already, you'll probably hear about it a number of times in the future, and we're going to show you how it relates to this later on in the video. Okay, so the first thing we're going to do is I'm going to break it down and show you all the different things that we're including on our statement here. So the first thing we include is the actual cost of the new bus, which is $100 million. And we actually see that the lessee in this case is going to save that $100 million because they're opting to lease the asset relative to buying it. If they bought this bus or whatever we're leasing here in this case, they would be at 100 million. So in this case, we actually include it as a positive on the statement because they're saving that 100 million that they would have spent in the other case. Okay, next we will consider the loss depreciation tax shield. So if you remember from the previous video, when we own the asset, we are able to depreciate it over its useful life. So in this case, we do not own the asset. We are leasing the asset. The lessor technically owns the assets in financing leases, although it can typically vary from case to case. Most cases, the lessor is the owner of the asset. So, the lessee cannot actually depreciate this asset over its useful life because they don't own it. Um, so we actually subtract that in our statement here, and I'll show you how we calculate that right now. Okay, not that. Okay, Okay, so here I have, go right here. We're going to use the MACRS 5-year depreciation as we used in the last video. And I have all the percentages lined up here. So it's 20% for year 1, 32% for year 2, 19.2% for year 3, 11.52% for year 4 and 5, and then 5.76% for year 6. And what we do is we actually multiply the assets value, which is 100 million, by these percentages, and it will give us a number that we then multiply by the marginal tax rate, which is 35%. And that number will give us our depreciation amount that if we were the owner of this asset, we would be able to actually add that back in our statement. But in this case, as I said before, we're not the owner, so we actually depreciate that. So 100 times 20% equals 20. Multiply that by 35%, you get $7. That's year 1. Year 2, we have $100 million. We multiply it by 32%. We get $32. Multiply it by 35%, and we get $11.2. Okay, that's year 2. Year 3, we have 100 million multiplied by 19.2%, gives us 19.2. Multiplied by 35%, gives us 6.72. Year 4, we have 100 million multiplied by 11.52%, gives us 11.52. Multiplied by 35%, gives you $4.03 for years 4 and 5. It is the same depreciation percentage for years 4 and 5, so the numbers are actually going to be the same. And then year 6, the last year that we depreciate the asset, so after year 6, the asset will be useless. It will have 0 salvage value, and we do not include salvage value for that reason in this. So for year 6, 100 million multiplied by 5.76% equals 5.76. Multiplied by 35% equals $2.02. So we will subtract these from the on our income statement as a lessee, as I said before, because we do not own the underlying asset. Okay. Next thing we're going to need to do, this lease payment you see here, this is a given number. I know in the previous example, we actually showed you how to calculate that amount using an equivalent 7-year annuity payment. However, we don't have to do that in this example here because this number is given to us. However, I showed you in the operating lease how to do that, how to calculate out the lease payment. So if you are interested and you didn't watch that video, go ahead and check it out. It's on my channel. So the next thing that we're going to need to actually calculate out here is our tax shield of the lease payment. And this is a stable, a constant amount. It is on the lease payment. So since we're leasing this asset, we're actually allowed to add back a tax shield because we have to pay taxes on our lease. So we will add back the amount that we pay in taxes on this lease to our income statement. So let me show you how I calculate this. As you see here, the lease payment is $16.9 million. Or I don't know exactly what the dollar amount, if it's millions, if it's just plain dollars, doesn't matter. So to calculate our tax shield on our lease payment, all we do is we take that 16.9 and we multiply it by 35%, which is the marginal tax rate, and you get 5.92. Okay, that is our tax shield on the lease payment each year of our lease. It goes from year 0 to year 7, and you add that back for each year, 5.92. Okay, now we have all the steps we really need in order to calculate out the cash flow of our lease. And as this is the same as in the last video, you just add each of these values in each column, add them together, subtract them, and the final amount is our cash flow from the lease. And these amounts here are not discounted to the present, so we're going to actually have to do that in order to get our NPV, net present value of our lease. Okay, so as you can see for year 0, I actually think I did these calculations, right here. So for year 0, we have 100 million from not having to buy the bus, and we have to pay 16.9 for the lease, and we actually save 5.92 on our interest tax shield. Final value for year 0, 89.02. Year 1, we have the $7 in the lost depreciation tax shield. We also pay 16.9 on our lease, and we receive back our interest tax shield on the lease payment of 5.92, gives us a final value of negative 17.99. Year 2, we have our loss depreciation tax shield of 11.2. We pay our lease 16.9, and we receive back our interest tax shield on the lease payment of 5.92. Final value for year 2 is negative 22.19. Year 3, you get the point. I don't really want to do that for um, all 6 years, or yeah, 7 years. Um, so you can look at my values here. You just add up the columns, and now I'm going to show you how to actually discount these values so you can get the NPV. So let me open up the other picture. Closed it. Okay, so in order to calculate our NPV of our lease, and this is the NPV of the lease relative to us purchasing the asset, or relative to us taking out a loan for the equivalent net present value, or present value of the asset that we pay. So the 100 million, taking out a loan for 100 million and purchasing this asset. So that is what we're actually calculating out here. So the amount that we get is how much we would either be left with as a gain or a loss relative to if we just said screw the lease and just bought the asset. So in order to do this, you just take our numbers here that we calculated for our cash flow of our lease, and you simply discount them by our interest rate, and we can determine that our interest rate after taxes is actually 6.5%, whereas before taxes it was 10%. So when you actually pay taxes on our interest rate, which I don't believe that we did in the previous example as the lessor, the lessee, since you do pay a lease, you can reduce the interest rate that you pay. So we would take the 10% and multiply it by 65%, which will give us 6.5%. Okay, so then we just take the cash flows, discount them by 1.065 to the power of the year. So year 0, that's going to be 1, so you just get 89.92. 17.99 divided by 1.065 to the first is going to be just 17.99. Or no, it's not. And then you see it. We did this before. You add them or subtract them rather together, because most of these are going to be negative, aside from the first one, obviously. And the number that you get is our NPV of our lease relative to buying the asset. And we actually get negative 0.7, which is equivalent to negative $700,000, because we're working in millions here. So that tells us that this lease is not very good. From a standard NPV standpoint, maybe in a future video I'll show you how with the APV, or adjusted present value, you can actually add in some side effects regarding taxes and some other things that will actually generally make this total NPV greater than 0, which makes the lease more attractive. But when we're looking at just the base case NPV in this case, you would be worse off by $700 million if you leased this asset, rather than if you just forked down the 100 million and purchased it. Okay, so that's something to consider, and that's sort of the core concept of what we covered today. If you guys have any questions, any comments, leave them below. And I know this is a little bit tricky. My explanation might be a little shaky, so let me know if you need another video, and I can cover the APV and show you how this lease can actually be valued a little bit more attractive when you think about some of the other tax implications. All right, have a nice day, guys, and I'll talk to you later.